All righty. Well, this is Linda Keith. I am the chief trainer and the founder at Lenders Online Training. And today I am here with one of my senior credit trainers. I say my, David, I take possession of you. One of our senior credit trainers, David Stoffaker. Welcome to our live stream. And today's topic is on estates and trusts, but not how you lend to them, more how do you treat the income and distributions from them to your beneficiaries, whether you are lending to an individual, considering a guarantor for a business loan, but that individual or guarantor is the beneficiary of an estate or a trust. Before we start, I'd like to also point out you have the ability to pop into comments if you'd like. And if you happen to ask a question that we don't answer in this live stream, we'll be sure to get back to you on that topic. So first, the background. If I have an individual, whether again it's borrower or guarantor, who is a beneficiary of an estate or trust, I may run across the income items on the back of Schedule E. So think about Schedule E in a 1040, front page is the rentals, back page we find the partnerships and S-corps at the top, and then at that next section down would be the estates and trust. So there it is, but just like the partnerships and the S corporations, it is a pass-through entity. So if there is a trust return, a 1041, instead of a 1065, 1120S, the numbers on the back of Schedule E are pass-through numbers. So David, what does it mean that they're pass-through, and where else might they find some of this income passing through on a 1040 from an estate or a trust?
Interesting question, Linda. You know what? I might answer that with maybe kind of a cheat sheet, so to speak, just to kind of give you an idea as far as how this works. Interest income passes through from this 1040, and it shows up on the personal tax return, the 1040 Schedule B. Some of us may be accustomed to where that is, where we see interest from other entities or interest from our checking accounts and banking accounts, etc. So it shows there also similar to where it may come from a 1065, a partnership or an S corporation. Interest may show up there. So what's interesting is the fact that in our learning modules, I just talked about it today, is in our cash flow analysis for tax returns, we actually talk through pass-through income specifically for those with 1065 partnerships and the 1120S sub-S corporations. But it also applies to this 1041 as well. Now, there was interest income, but what about capital gains? Well, that passes through to the beneficiary as well. It's probably going to be showing up on the Schedule D, which isn't a surprise to many of us on this call, but in a separate section. It's kind of located right on the bottom of it, which is probably easier to reflect upon because it kind of stands out there. So that's dealing with your interest income as well as your capital gains. Now, some of the other income and losses show up on the 1040 and Schedule E, which Linda mentioned a little bit earlier.
Well, what's interesting about that is why the heck do they have it coming in all over the place? This is the same with those pass-through entities, the S-corps and the partnerships. Income deductions and credits often have to retain their character when they go into the 1040 because there's something going on in the 1040 that needs the information. So as David pointed out, a bunch of it's going to be back on the Schedule E at the bottom where we're kind of expecting it, but it could be elsewhere as well. So that takes care of where it is. And the point is that just like the S-corp, just like the partnership, those pass-through items are non-cash. Every time, no matter what, no matter where you find them, no matter how big the income or loss is. If it is a pass-through from a 1041, 1065, 1120S, either on the back of E or elsewhere, it is not cash flow. And we don't lend on taxable income. We lend on cash flow. Cash flow. So the question becomes then, okay, Linda, you've got me convinced. Don't use the numbers on the back of E and don't use these pass-through numbers on B, on D. Don't. Okay, if I've got you convinced, then you might be wondering, Linda, what do we use? Well, again, I'm going to tie this back to the S-corps and the partnerships because that's what we're more familiar with. Well, the 1065 K1, 1120S K1, we can actually find the distributions that have been made, the actual cash flow numbers. And in our training on tax return analysis in the Lenders Online training, we give the formula. What are the numbers on the K1 that actually mean cash flow versus all those other numbers that we get to ignore? The trick here is the 1041 K1, 1041 being the estate and trust return. 1041 K1 does not give a figure for distributions. What? That's right. It doesn't tell you. So when you have a borrower who does have income showing up from on 1041 or 1040 Schedule E from an estate or trust, and you determine that it's significant enough, could be recurring, you'd like to find out what that cash flow is, then you're actually going to have to ask the borrower. You may be able to get a trust distribution schedule from the accountant who did the trust. You may be able to actually, and should perhaps, look at the trust agreement itself. Does it say on what basis do we make distributions? Does it say how often it happens? And I think that's important even if the number you're seeing on the back of Schedule E seems to be consistent and significant. You might go, okay, that must be continuing. Again, the number on the back of E is taxable income, not distributions. But second, you cannot tell by looking whether, if it is a trust, it's a complex or a simple trust. And complex trusts are those ones that have unusual or maybe more complicated rules. As an example, perhaps your borrower, as a beneficiary, is receiving $20,000 for every semester they're a full-time student at college, and they just graduated. So yeah, they have been getting money, but the basis for them getting it is something that now is done. So we need to know how much they've really got. It does not show up on the 1040. It also does not show up on the 1041 K1. So you're going to need to ask and get other kinds of documentation to get comfortable with how much they're getting and how much you can count. David, did we have anything else we're going to try to tell them about this? I think we might have covered it.
I think we covered a lot of that with regards to it. I think it still comes back to, on some of our, when we're underwriting clients, if we really need this type of cash flow, or really trying to understand that we need this to qualify or borrow, we're going to ask questions, right? If it's significant enough, we need to understand if it's going to still be there or not. Otherwise, we actually leave it out, what we mentioned before.
And I'll give you a little twist in case it's an estate and not a trust.
Yes.
I just closed out hopefully within the next month. I'm finishing up as the personal representative for my 100-year-old mother-in-law who passed this year, as well as my brother. If you were just to look at the estate and think, well, you know, the estate will close out, but the beneficiaries will probably receive income or other assets from the estate, so maybe I can count them anyway. Again, you need to ask questions. It happens that my brother did not have children, and he decided that after he passed, the entire proceeds from the sale of his house would be donated to St. Jude's Children's Hospital. I'm blessed to be the one to be able to carry out that wish of his. But if you just looked at what the estate had in it and assumed the beneficiaries would get that, that would have been way off. So again, estates, sure, they're going to close out. Sure, there's probably assets that might come to that beneficiary that could be rentals, could be cash, could be tied up in IRAs. So you'll need more information if you think you want to pursue what will happen after the estate closes. We have a question showing up. It says, if we have a living trust, would you agree then the activity should likely not be included in any individual's global cash flow analysis? Well, I wouldn't agree with that, Michelle, but let me explain why and then make sure I understand your question. With a living trust, also called a guarantor trust or even a revocable trust, that is when someone, say, puts their home into a trust. They are the guarantor. It is revocable as long as they are alive, but the purpose is to get it out of the probate process so that we don't have to go through probate when it's time to actually resolve the estate or the trust. An estate turns into a trust at the time that they pass away. So why I say that you could count it is because if it is a grantor trust or a revocable trust, it's actually not going to show up on the back of Schedule A anyway.
Right.
It's going to show up right in their tax return as if it was them personally. So you're not going to see a K1 for it, but what you are going to see is if I do have a rental property that's in a revocable trust, it's going to show up on my Schedule E page 1, just like any other rental. And if there's capital gains or interest, it's actually going to show up just as if it's mine personally. And yes, we will count it because, again, that type of trust is completely revocable. I could change my mind. I got the rental back. I have the money back. I have the stock back. And I therefore continue to have the benefit. The moment that person passes away, it becomes irrevocable. And in both of the estates I'm working through right now, we had grantor trusts that are now irrevocable. I cannot, as the representative, I can't change anything about the trust. All I can now do is carry out the wishes of the individuals involved. So just go ahead and pop back in. Did that answer your question? I saw where the question showed up, so I'm not sure where I'm going to see the answer.
I mean, thanks for the question, Michelle. That was a great example as far as understanding, having a deeper understanding of these tax returns and how it actually leads to more relevant questions. And we understand deeper as far as what the assets are, who owns them, where that cash flow is moves forward. I mean, it's a goal of what we do here, trying to get people beyond the number crunching, but to understand what's behind the whole borrower's cash flow, understanding and where that flow is. Remember, it's cash that repays debt.
And often your borrowers are confused. I will tell you that after the passing of my relatives, I'm applying for the EIN, the number from the IRS that will allow me to open those accounts. And it asks, is this a revocable or is it an irrevocable trust? And I kind of went, well, it was revocable, but now they're passed. So I think it is irrevocable now. And even the attorney at the darn bank I was trying to open the account, they got confused.
Yeah.
So some of the terminology, whether it's grantor or what, can be confusing. But from a tax standpoint, if it is revocable, and that's what we often call living trusts, then it just shows up as if they own it. And frankly, they still do. They have complete access to it. All righty, that is it for today. You're always welcome to ask questions at experts@lendersonlinetraining.com. We're happy to answer them. Sometimes they are what the next live stream will be about. And thanks for joining us today. Bye.